Okay, so what are the myths about reverse mortgages? Before I go into this, what have you heard about reverse mortgages?
I don't know, it sounds kind of sketchy, reverse mortgage. That they're expensive. Is that too good to be true, reverse mortgage?
Right, right. You're just kind of not quite sure what it is. And you know, it's kind of interesting because in Taiwan, they call it a home pension. In England, in the UK, they call it an equity release, right? But in the U.S., in the U.S., we have to say reverse. It's kind of like, you know, right. So the myths. Number one, lender takes your home ownership. Absolutely not. It's your house. It belongs to you. It's just like a regular mortgage in some respect. In that respect, the lender does not want your house. They're not in the business of taking homes and selling them. Number two, requires monthly payments. It does not. That's the beauty of a reverse mortgage. Now, the thing that's interesting about these equity release or home pension plans is that you have your choice. You can make a payment, you can make an interest-only payment, you can make a full payment or no payment. So there's a huge amount of things that you can do with it. Three, heirs must repay the mortgage. No, the deed is secured against the house. It's only against the house. So if by chance the value of the home is less than what you owe by the time a person in your family dies, it's called a foreclosure, just like a regular loan would be if someone that was upside down. Now, seldom does that happen anymore, simply because they've changed the rules. There's been massive changes on these programs, and they're not like what they used to be. They're really much different today. And we'll talk about that a little bit in just a little bit. You must apply to be able to qualify for traditional financing. Absolutely not. We had a lady who was served notice that she had to move because she didn't make her payments on her house. She went out to the gate one day and saw this packet from a lender and said, "Your house will be sold on the steps of the city hall." Right? She had made no payments because it was COVID, and then after that, she couldn't make any payments because her boyfriend, who was supporting them, died of COVID. And she had a beautiful home in Los Angeles. It was worth quite a bit of money. Didn't owe a lot of money on it. And with very little income, we pulled her out of that with a reverse mortgage. She got the money she needed to repair her house. She's living in the home. She's aging in place. I mean, it changed her entire life. And she has no payments that are required. Now, that's amazing, isn't it? It really is. Continuing, home must be debt-free. Nope, you can have a mortgage on it. We'll show you an example of that in a minute. Lenders want to sell your home. They want nothing to do with selling your home. That's not their job. I will have nothing for my kids. Now, this is a big one, right? A lot of people believe that it's either I've got to maintain my lifestyle or I'm going to leave money to my kids. That's why we have seniors that are eating Cheerios all day long, right? Because they believe that they got to give something to the kids and nothing will be left if they get a reverse mortgage. It's really sad because they're eating spam when they don't really need to. And then the other one is, I cannot sell my home. You can sell your home anytime you want. It's just like a regular mortgage. You can sell it whenever you want to. There's no prepayment penalty on it. There's no restraints. There's nothing like that. Okay. All right. Any questions about these before we go on? All right. Okay. All right. And so what we talk about is we're talking about aging in place, which means your ability to choose to stay home or to go to live with a family member or what you want to do. But we believe that aging in place, and this is not and I got to be real careful about this because there's a lot of different quotes and a lot of different people that put out, information. But the average person, when they enter assisted living, how many die in the first year? You got an idea for me on that? Yeah, 65%, right? It's a big number. And it's because you're taking your parent out of their environment where they've been for all these years, and it blows it apart. It's really difficult. Now, that's not true in all cases. I don't want to generalize it, but it really needs to be understood that when you transfer, when parents say, the children say, we need to move mom out so that we can pay for her care, I mean, they're basically saying that we're going to shorten their life. At least that's what's happened on record. Okay, so the idea of aging in place is, number one, to mitigate retirement risk and maintain your lifestyle. That's number one. And number two is to leave a legacy for your loved ones. That's if you want to. There are parents that don't want to, right? They don't care about leaving money to their kids, right? They just want to spend it, which is great. It's whatever they want to do. The idea is that people think that these are mutually exclusive when actually you can actually do the same. The goal of this is by an author named Wade Powell. The goal of climbing a mountain is not just to make it to the top, but it is also necessary to get back down. The skill set required to get down the mountain is not the same as that needed to reach the summit. Going down, one must deal with greater fatigue, falling further with greater acceleration when facing a downslope than when facing an upslope. Going up is easier than coming down. Just ask anybody who's climbed Mount Everest. It's really tough coming down. It's not an easy job. Going up is our working. Coming down is our retirement. And so the risk in retirement are a little bit different because it's longevity, how long you're going to live, what the market risk is for your money, and spending shocks. So if you have to go to the hospital, or you got to have a wisdom teeth, or you got to have a root canal, or whatever it might be, you have standard income, but you also have these shocks that come up and down throughout the time. Okay, retirement could become quite expensive when a long life is combined with poor market returns and significant spending shocks. So you have to be really careful. That's where the planning comes in. All right, so there's a financial planners use sequence of return risk. And sequence of return risk basically means that I have $850,000 or whatever the money I have here. I think I'm going to live about 30 years. How much money will I get every single month from that $850, right? That's sequence of returns. The risk part of it is how likely is that to happen, right? And so sequence of return risk is a fascinating concept in that minor spending tweaks can have major implications for portfolio sustainability by impacting the amount of investment wealth that remains at the end of the plan's horizon, in this case at the end of life, right? So here's an example. Dow Jones Industrial is now at 40,000, right? Or about there. It's teetering between. 850,000, 30 years. This person who's planning that 850,000 will get a set amount for the next 30 years. You with me on that? Okay. All right. Now, what happens is when we get a shock to the market, it's called exogenous forces, things that come up that we don't plan for, that we don't know, is what happens is the same thing, but now what's happened is that your market goes along, the Dow Jones goes along, and all of a sudden it drops 5,000 points. Is that possible? Well, yeah, it's possible. Well, what happens is during the time period that you are in the process, you still have to eat. This could be months or years. It doesn't really matter what the shock is, but the idea is that during this period of time, you still have to live. And so as a result, if you are drawing on your assets while your investment portfolio is actually decreasing in value, then you begin to start taking the seed money. You begin starting spending money on the stuff that's generating the interest. And when that happens, all of a sudden your time frame will be shortened. And it can be massive. I mean, in this, it depends on the shock that comes to the market, but the basic idea is what you had set up for 30 years could end and only be worth 10 years. Did I explain that okay? Mm-hmm. Now, you might be thinking to yourself, well, is that possible? The market's doing so well right now. The problem is it only takes one or two shocks. It only takes a couple times. It only takes a dip to be able to make it so your horizon is shortened substantially. Did I explain that okay? That's a really big deal, very important. Okay, all right. So money left to heirs. So let's just talk about that. Here we have someone, retirement planning. They retired. They still had a lot of money left, right? But they used their reverse mortgage as a last resort. And the money that they left, and this is in Wade's book, the money they left was $1,757,000 to their heirs. Now that's really a great accomplishment, right? Okay, now when they use the reverse mortgage, in other words, they took a reverse mortgage, because a lot of people think that reverse mortgages are only for last resort. This is actually for actual planning. In other words, it becomes part of the retirement plan. So they get it when they necessarily don't need it, right? When that happens, retirement planning with 10-year payment. 10-year payment means that they're going to get a monthly payment for the rest of their life based on the value in their home. Well, it just so happens that when they use that same period of time, same market conditions, everything the same, it's now $2,644,000. So it's almost $1 million more left to heirs as a result of using a reverse mortgage. Yes?
You're going to explain how we do that, right?
Yes, yes, right.
Yeah, wait.
Now it's going to be, it's not going to be this number, right? But it's the idea that we're talking about here. So we'll give you a little bit of idea on that. Okay. All right. Now this, I know the rule is you never show little numbers on screens, but this chart makes me weep. For a guy that's really into numbers, I love this chart. And the reason why I like it so much is that it is the amortization schedule that we provide all of our clients when they're looking at whether or not finding out if a reverse mortgage is right for them. It's changed a lot. The most important thing is to ask the question, is it right for me, right? And so this is how we present it. And this is based on, whenever I do this proposal, at this particular, these individuals were 79 years of age. It always falls to the youngest of the two. 79, and all the estimates are based on 100. So everybody will live to 100 that hears today. That's good, all right, in good health. And what happens is age 79, their loan balance that they got was $265,000. They had to pay off an existing loan. And based on the equity in their home, they got also a line of credit for $130,918. Okay, so what people don't realize is that depending on the equity that you owe on your home and your age, you can also get a line of credit with these. And these lines of credit are a little bit different because they are guaranteed. If you get a line of credit from a bank and say, I want a line of credit, they can call you anytime and say, we're going to pull it. They can't do that with a reverse mortgage. It's for the rest of your life or as long as you live in the property. It has to be a primary residence. Okay, so in this case, they get a line of credit for $130,918, and their equity position at the time that they get their mortgage in year 0 is $584,818. All right? Now what happens is let's go to year 1. So after year 1, they're 80 years old. They have mortgage insurance and they have interest. They didn't make any payments. Their loan amount is now $283,674, right? So the balance has gone what? Up, okay? That's called negative amortization. That's why it's called a reverse mortgage. A forward mortgage is one that you pay down. A reverse mortgage goes backwards. And so with a reverse mortgage, your balance on your loan will grow. Now, what's interesting is that from the HUD of Home and Urban Development in the United States, they basically say on their documents that, generally speaking, your home will appreciate 4% a year. Now, in California, it's a little bit different. It usually is quite a bit more, isn't it? Okay? But at 4% a year, after the first year, the equity in their home is now $600,326. The equity has increased because the value of the home increases so much faster than the loan because the loan is so much smaller. Does that make sense? And that's what people forget with reverse mortgages, is that if you keep your money with your financial planner and let your money scale up and just grow, and you utilize when you need it from your home, depending on how you want to plan it, it's beautiful, and it's beautiful for one reason, is that people forget. They think about this loan balance increasing, but they forget about this side of the equation. And so when your value of your home is growing faster than the actual loan, then all of a sudden you're living in that home as if you were for free, basically, because now will it always go up 4%? No. Sometimes it'll go up 10, but sometimes it'll only go up 1. Sometimes it'll be negative, but generally speaking, it will rise. And so when you take a 4% raise into account, you'll notice that the equity position continues to increase the entire term that they're in the property. And that's without making one payment. Now, another thing that's important isn't that cool? Yeah, that is really, that's powerful, isn't it? Now, you'll notice here the line of credit. Do you see how the line of credit is actually growing each year? Well, right now, we don't know how long this will last with reverse mortgages, but it's really a big deal, is that automatically, based on whatever the rate is at the time, your line of credit will grow. So the less you use, the more you get. And so your actual line actually grows over time. It's almost as if you were in the market, but you're not in the market. And it grows between 5 and 8% depending on what is going on in the market. So the less you use, you'll see that it grows. So let's say that in year 9, they need to have some money. There's some shocks that came up. They can have access to $240,000 when before they had access to $130,000.
When they use that money, year 10, they use $240,000.
Uh-huh.
Do they have to make a payment on that?
No.
No.
No payments.
Still no payment.
No payments. But what it does do is it adds to the loan balance,
Sure.
so the equity is not going to grow as quickly.
Perfect.
Right? Okay. So there's always going to be an offset between them. The idea is that you have the ability to withstand the shocks when they come. And that's what a reverse mortgage is all about. It's a tool that can be used that is so important to understand about the benefits that you can get from that. Okay, what questions? Yes?
Who invented it? Like, did HUD come up with it, or was it, I'm just curious.
You know, that's a good question. There were some private people that began working with it and began doing that. And then the HUD, they realized that it was a good thing to do, and so they began to introduce the concept of the reverse mortgage. And then it came to be formalized as a regular loan. It was only for refinance purposes. It wasn't for purchase. Now you can refinance or purchase with them. And the whole concept was really enlightening for seniors. The problem is that the way that they brought it out, it was a predatory product. I mean, it was just pure predatory product, right? In fact, when I didn't actually start doing reverse mortgages until many years into my practice. And when I saw the amount of commissions that were being paid, I just thought, this is not going to last long. I mean, you know, it was absurd. And sure enough, they've made big changes. The big changes is they don't pay as much as they used to, so there's less chance of the house going upside down. There's less mortgage insurance on it. There's the way that they have the payouts on these and the way that they're sold on the secondary market is different. Everything is different. And so now they're really a very good product. They still have to be structured correctly, but they're not predatory, as long as they're structured correctly. Did I answer your question okay?
Sort of, I mean, I was just wondering, does HUD guarantee them? I mean,
Yes.
yeah.
Yes. So in other words, if for instance an individual dies and the house is upside down, right, then the Ginnie Mae or the agency that insures these will pay the bank the difference.
Oh, okay.
Yeah. Yeah, these are insured. This is an FHA product. Now there are also jumbo products. So, and we can get in, and you can call me and ask me about it. But when you get into the jumbo products, they have loan amounts up to $4 million. Yes, David.
How's the changes in interest rates affected all that? Can you talk a little bit about that?
Well, yes, the change in interest rate for the FHA has been fine. It's an adjustable rate mortgage. You can also have a fixed. It's around 8% right now. And the adjustables are around 7.5%, 7.375, somewhere in that range.
Your chart, is that based on like a fixed rate?
No, this is based on a line of credit. Anytime there's a line of credit, it's always an adjustable rate mortgage, right? Good question, yes.
I have a bunch of things.
Yeah.
Okay, I've actually seen presentations where a very wealthy person, they're suggesting they do a reverse mortgage and then they take the money and they actually make investments and they build their equity that way.
Oh
too.
yeah, they can do that. If
They
they're,
can- So they manipulate that, which parlays into you could have a reverse mortgage and buy the long-term care insurance. So, you know, that ends up, so the lump sum, having that done. Where I'm confused is, how old do you have to be?
62.
What's the difference between how much equity, is there a percentage of the equity?
Yes, good question. So the younger you are, the more equity you need. The older you are, the more money they give you.
Wait, let's do that again.
Okay, so the older you are, the more money you get.
It's better to be old. The older you get, the more money you get.
Right?
Yeah,
So if you're
it's like
62 years old,
from like-
you'll get about 40% of your equity less whatever you owe.
Okay,
But as you age, around 80, 85, then they'll actually give you more money. The older you are, the more money you receive because your life term will be shorter.
so you never owe on it if you get it at 62
Mm-hmm.
and you're getting 5,000 a month
Okay,
and you live to be 97,
okay,
and it goes above the amount of equity.
Okay.
It's more than the equity in the house.
right.
Then the bank now owns it.
No, you own it. You still own it.
No, I'm dead now.
Okay, then your family foreclosed on it.
Okay, so, and it's a wash,
It's a wash.
right? Okay, so do you ever tell people who are thinking about they want to age in place, do you ever suggest to somebody wait till you're 75?
No.
No.
It's all based on, what we do is we base what their equity position is at the time and whether or not they qualify and whether it makes sense at that age.
So there's no like speculation if you waited this number of years or that number of
Yes, we can do that. If you want to say, well, what would it look like if I did it at 62 and 70 and 75? We can tell you all of that.
But that's also speculating what the value of the equity in the home is.
Correct.
Interest rate.
Right. Yeah. Yeah, and that's why it's usually better to, if you can qualify in the beginning, in other words, if you have enough equity in your home, you want to explore that opportunity.
And you, I'm sorry, and you also said if you change your mind and you move,
Mm-hmm.
what happens? It's just the difference.
You sell the
It's
house.
just the numbers.
Right. Right. It's just basically what you owe at the time, what your loan balance is, and you sell it. And go ahead.
Well, I've heard people say, well, you do a reverse mortgage if you know you're really going to stay there.
You should because they're expensive, right? They're not cheap to get into.
Because up front, there's that.
Mortgage insurance and things like that. So, and we can talk about that at some point. The idea is that if you're going to get one, you want to live there for at least 4 to 5 years.
4 to 5 years.
Yeah.
To
Yeah.
make it worth it.
Yeah, you got to be there for a little while. Yeah, yeah. Yes.
Just a quick question about the process. So you do a reverse mortgage, you're there for however long, you pass away, you still have equity in the house. What is the process? Does the heir sell it or something?
Great question. So the process is that you have 6 months to dispose of the property with 2 3-month extensions. What's that?
When you say you have 6 months, you mean the heirs?
The heirs. Yeah, yeah, because you're dead. Yeah. So the heirs have 6 months, and then they have 2 3-month extensions. So they can have up to a year, right? And a lot of times the heirs will say, well, I really like that house. I want to buy it, right? They can buy it, and if the value of the home has gone down, let's just say that's a worst case scenario. Let's say that there's more owned on the house than the house is worth, and the value of the home is down. The heirs can buy it for 95% of what the appraised value is at the time of death. Right? 95% of what it's worth. Right? Yeah. So for purchases, they're a dream. Yeah, I mean, for purchases, you cannot. We've had people come to us that cannot qualify to buy a home on their own, but they're of age. They had a big down payment. I mean, it was heaven for them, and it's heaven now because they moved down with their grandkids. It's always moving. It's my grandkids. They're my children. It's your grandkids. So, all right. What questions do you have before I finish up here? All right. So let me take you through this real quick. If you're interested, let me know. I'll send you a copy of Wade Powell's book. This is a really amazing book. The reason why it's so good, he's a PhD in financial planning. PhD, really a smart guy. But what makes him different is he does not do reverse mortgages. He has no tie to it whatsoever. So the book is really, really good. In the packet that we have for you today, you have one by Robert Merton. Robert Merton was a Nobel laureate. He came up with a financial model called the, well, I don't need to, it's a Black-Scholes method, but the guy's smart, and he talks about reverse mortgages. Then you'll see another one in here that is peace of mind. This is something that we designed. It would be a good thing for you to read it. And then the myths, and then of course you've got my beautiful mugshot on the other side. You know, this tells a little bit about us, and my card is in there. So, and I also want to thank Gina for putting this together. Gina, you did a great job. Okay, and we'll be around to answer any questions.